The signal never announces itself. It never rings a bell or flashes across a screen. It moves quietly, almost politely, through balance sheets, bond markets, currencies, and capital flows long before headlines catch up. Here's what nobody tells you. By the time optimism becomes visible, the real move is already half over. Smart money never waits for certainty. It waits for asymmetry. And right now, some analysts suggest that asymmetry may be quietly reappearing across global markets. This is where the pattern begins. Every major financial turning point in modern history follows a similar sequence. Not because investors remember the past, but because incentives never change. In the early 1970s, inflation crushed purchasing power, equities stagnated, and confidence collapsed. By 1974, the S&P 500 had lost nearly 48% from its peak. The public retreated. Yet between 1975 and 1982, while inflation still dominated headlines and interest rates climbed toward 20%, institutional capital slowly began repositioning. Not loudly, not emotionally, patiently. When the recovery became obvious in 1983, the biggest gains were already locked in. Here's why this matters. The 5-stage capital cycle always starts in discomfort, not celebration. Stage 1 begins when fear remains high, but downside momentum slows. Stage 2 appears when liquidity shifts into assets nobody wants to talk about. Stage 3 is disbelief. Stage 4 is participation. Stage 5 is excess. Most people only recognize Stage 4. Smart money lives in stages 1 and 2. At first, it looked like a miracle. Then, the bill arrived. The late 1990s are often remembered as a single, uninterrupted boom. But beneath the surface, capital told a different story. By 1997, while technology stocks surged in price, certain institutional flows quietly rotated into bonds, defensive assets, and cash equivalents. Volatility compressed. Credit spreads narrowed. The crowd saw innovation. Capital saw fragility. Here's the mechanism. Price can lie for years, but capital positioning rarely does. Everyone thought they were safe. They weren't. When the dot-com bubble finally broke in 2000, losses didn't arrive evenly. They hit last participants hardest. Those who followed excitement paid the price for ignoring early signals. Not intelligence. Timing. Not optimism. Structure. That divergence between narrative and capital flow is where smart money earns its edge. Some economists argue that a similar divergence may be forming again, though outcomes remain conditional. In recent quarters, global capital flows have shown tentative shifts toward long-duration assets, select commodities, and undervalued equity regions, even as retail sentiment remains cautious. Not panic, not euphoria, suspended disbelief. This is the most dangerous emotional state in markets, because it keeps participants frozen. Here's the trap. People look for reassurance when the opportunity demands conviction. They wait for headlines to agree with balance sheets. They wait for certainty in a system that never provides it. Smart money doesn't predict the future. It prepares for multiple futures. That preparation always starts quietly. The danger wasn't what they saw. It was what they ignored. And right now the question isn't whether markets will rise or fall. It's whether this early signal represents the beginning of confirmation or the last calm before a very different outcome. Confirmation never feels dramatic at first. It feels confusing. That's the moment when the pattern either locks in or violently fails. In the late 1990s, disbelief lingered even after capital had already repositioned. By early 2001, when layoffs accelerated and earnings collapsed, the story finally changed. The crowd reacted. Smart money had already exited risk. That delay wasn't accidental. It was structural. Markets reward those who move during uncertainty, not those who wait for clarity. Here's what nobody tells you. Capital doesn't chase growth. It anticipates regime change. After the 2008 financial crisis, global markets offered one of the clearest modern examples of this pattern. In March 2009, with unemployment above 9% and global trade contracting, institutional investors quietly began re-entering equities and credit. Headlines still screamed collapse. Fear dominated sentiment. Yet between 2009 and 2013, while public confidence slowly recovered, Asset prices more than doubled in several markets. The move didn't start with optimism. It started with exhaustion. This is where the pattern repeats. Stage 1 appears when selling pressure fades, but belief doesn't return. Stage 2 forms as capital reallocates toward resilience rather than growth. Stage 3 arrives when skeptics outnumber believers, but prices grind higher anyway. Stage 4 brings validation. Stage 5 brings excess. Analysts suggest that today's global economy may be hovering between stages 1 and 2, but only if certain conditions hold. Here's the mechanism. Liquidity doesn't disappear. It changes hands. When central banks tighten, capital doesn't vanish, it concentrates. It seeks safety, yield, and optionality. Some economists argue that recent movements in global bond yields, currency stabilization, and selective equity accumulation suggest positioning for multiple scenarios rather than a single forecast. Not collapse, not boom. Optionality. Here's why this matters. If the pattern confirms, the next phase doesn't require explosive growth. It requires stability. A soft landing scenario would involve controlled inflation, modest growth, and gradual risk re-entry. A structural reset would involve sector rotation, regional divergence, and uneven recoveries. A hard break, still conditional, would emerge if credit stress or geopolitical shocks disrupt liquidity flow entirely. None are guaranteed. All are possible. Not prediction, preparation. That's the difference. Smart money isn't betting on outcomes. It's betting on asymmetry, limited downside, open-ended upside. It accepts being early because being early is survivable. Being late is not. Here's the trap. Most people confuse movement with meaning. They chase price instead of position. They wait for narratives instead of watching flows. They assume comfort equals safety. It doesn't. Comfort is usually the signal that risk has already transferred. The pattern doesn't promise rewards. It offers a choice. Observe and react, or recognize and prepare. Because when confirmation finally arrives, it never feels like opportunity. It feels like relief. And by then, the smart money has already moved.